Hi there. Now, as we discussed in the previous video, the naked strategy is a reversal strategy that looks to capitalize on the big reversals that can often be found at the tops of uptrends and at the bottom of downtrends. Now, you'll know that we look for specific candlestick formations or patterns to give us the early warning signs that a reversal is about to happen. However, we don't take these signals blindly. Every time they appear, we don't just take and fire off a buy or sell signal. No, we need to do some further analysis. We need to identify the high probability areas which will ultimately give us the winning edge that we need, and that's what trading is all about, right? So where are these key areas found? Well, to put it in simple terms, they're found at major support and resistance levels on the daily chart, the higher time frame daily chart. So I know support and resistance is a buzzword often used by people in the trading business, but what does it actually mean? Let me briefly explain what we mean by support and resistance. Support and resistance are basically horizontal lines drawn on a price chart where price has respected and generally reversed in the past on one or more occasions. Now, as you know, markets are made up of buyers and sellers. That's what makes a market, yeah? When buyers are more prevalent in the market, like here, prices are rising. More buyers than sellers means the prices go up. When sellers are more prevalent in the market, clearly prices tend to fall because the sellers have control over the market. Now, often buyers are referred as the bulls and the sellers are referred to as the bears, another buzzword you might get familiar with. So why would a trader want to buy a particular market, no matter what entity it were? Well, clearly, if you want to buy a trading entity, the hope is that you can sell it in time for a higher price in order to capitalize on a profit, in which case you would become a seller when you finally sell to lock in that profit. Now, when we're trading Forex, we also have the ability to sell first in the hope that prices fall and we can buy it back later at a cheaper price and lock in that profit. So if we're selling, we then become a buyer to lock in that profit. Now, it's human behavior. Buyers becoming sellers and sellers become buyers because, of course, we need to lock in to establish those profits. And where they change from buyers to sellers are the turning points, the support and resistance lines. Now, as technical traders, we believe in human nature has the tendency to repeat itself. So we look back in charts to see the key turning points of support and resistance. Now look here, you'll see here the market is trading up. The market is moving up, buyers have control of the market. At some point, all these buyers will want to establish a profit. Now when these buyers turn into sellers to lock in their profit, it puts in a reversal. And then the prices move back down as the sellers now take control of the market. The sellers are more prevalent. And at some point, the buyers will come back into the market and start buying again. And they buy it all the way back up and they look left on their chart to see the last time we were up this level, we saw the sellers coming in again. So we believe the sellers will come back into the market again. This is creating now a level that's been respected more than one occasion. Here, it's been respected twice. This is now becoming a level of resistance. We now understand that every time markets gets up to here, it's got a strong probability that it's going to reverse back. This is a resistance line. Put the R in there. And then prices indeed move back down again. You've got a minor support in there, bounced off it a couple of times, and then markets move back down again and we go into range, and then the markets go back up again. And you can see here, we come back up to our level of resistance, and the markets come back down, and you can see we're coming back down to this previous level of support. Here we bounced off support on a couple of occasions. After this move down, it looked back left on the chart, you can see it was respected before, it bounces off again. So these are basically the support and resistance lines and exactly how they fit into our price action. So we look back on our left of our chart to see where the lines of significance were respected in the past. Now it's important to note that support and resistance can be drawn on all time frames, from the yearly right down to the 1 minute chart. However, the higher time frame, the more significant these levels tend to be, simply because there are more market participants in the higher time frames than there are on the, say, the 1 minute or the 5 minute. So in the naked strategy, we look at the daily time frame, much more significance, and the higher time frames. It's also worth pointing out that support and resistance lines are not red lines in the sand that cannot be broken. They are broken from time to time, or else there simply wouldn't be trends in the market. But if you can use these in conjunction with other price action signals, such as the ones we discussed, the pin bars and the engulfing patterns, they can be very powerful in predicting the turning points of a market. And this is the very basis of our naked trading strategy. Now, traders often use support and resistance to assist not only in entering trades, but also to exit trades as well, for the purpose of locking in a profit or indeed cutting a loss. And it's often the case that once a line of resistance is broken, that often becomes support as well. So old support can become resistance, and old resistance can become support. So an understanding of what support and resistance lines really is very, very important. It's crucial, in fact, if you want to be successful as a trader, and indeed if you want to master the naked trading strategy, which is what this video series is all about. So now let's jump onto the screens and I'll show you exactly the best way to draw these support and resistance lines on a real price chart. Come on. Okay, so here we are now on the daily chart. This is the euro against the United States dollar. You can see here all the different candles showing all the detailed price action that occurred on a daily basis. Now here you have all the green candles. This is showing you that the buyers were in control, taking the market higher. And then we had a turnaround. The sellers took control with these red candles and took price lower. So remember, each candlestick represents 1 day's worth of trading. And you will recall from our previous video on the candlesticks that a candle shows us lots of information, 5 bits of information. It shows us the open, the close, the high and the low depicted by these wicks, and of course the colour of the candle indicates whether it was a bullish day, the buyers in control, or a red candle would indicate that the sellers are in control, a bearish candle. Now all this looks rather confusing when it comes to plotting your support and resistance lines. So what we need to do is to remove all the noise from the chart. We're not interested in the highs and the lows of a particular day. We're more focused on who won the battle in a particular day. Were the buyers in control or were the sellers in control? And in order to do this, we need to be looking at the closing price of a particular candle, in this case of a particular day. And the best way to do that is to not use the candlestick chart, but to toggle over to the line chart. And we do that by clicking this line button here. Now you can see here, all is a lot clearer. What we need to do now is plot in our support and resistance lines at key turning points, or levels that have been respected more than once, so basically twice or 3 times. So let's plot a line in here. That was respected there and there. That is going to be a level of support. And up here, that was a key turning point. And indeed up here as well, a key turning point in this currency pair. And indeed, if we look lower, you can have another line in here respected here, 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 here. We can put in a support zone down here. The base of this move also respected back here. You might even plot one in there as well. This is where this ascent stalled and went back. Now the trick is not to place too many lines. Of course, we don't want so many lines on the chart that we're not going to be able to trade, but the key turning points or levels that have been respected more than once. And once we've done that, we toggle back to the candlestick chart and everything becomes a lot clearer. So the idea is to do this every so often, maybe every 2 or 3 days, once a week at least, and then you can keep your charts current with the latest support and resistance lines, because we're going to be using these lines as our key turning points and we'll be looking for our candlestick formations to appear at these levels to give us clues of the big reversals that we're looking for in this naked strategy. So you can see this really is the best way to draw your support and resistance lines. Remove the noise, remove the wicks, just look at the closing prices, and we do that by using the line chart.